Hi everyone, welcome to Flux News Show. I'm Greg Newman, Chief Executive of Onyx Capital Group, joined with partner in crime Harry Campion from Onyx Markets. Morning. And Vincent Wu from Research. So thanks guys. And just a quick reminder, this is all about trying to be a lot more trade focused. We're trying to help people understand how our Flux product works, how it can work for you, for trading. Onyx Markets as well, of course, the only free oil trading platform out there, best prices, yada, 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 yada. So let's just go straight into it to give that kind of market color, hopefully add a bit of value. So from the off, I guess we're starting with what the temperature is. Okay, so I think we think the market's pretty hot. I mean, you start, Harry, because we were debating this a little bit, like what constitutes it being hot?
We were. So we've had two decent movers this week, one especially in dated Brent.
Yeah.
Had a kind of shock move to the upside, and then a more orderly move up in gasoline.
And an orderly move up in Brent still, right?
And an orderly move up in Brent. And yesterday you had that kind of breakout to the upside. So three decent moving markets. So hot market.
Yeah, hot market. I think volatility in Brent spreads and I guess WTI spreads as well. Just things kicking off, right? I mean, like you have to say, okay, not the most hot market, but like it's been a bit uncertain for a while, right? People have been waiting for this sell-off or whatever you want to call it, like, or the Trump stuff. And now it's like, actually, this has obviously been an opportunity to make money for some traders, right, Vincent? You'd say?
Yeah, for sure. I think previously the market was quite bearish on expectations of an oversupplied market. The crude oil the balances were showing a deficit.
Yeah.
Oh no, sorry. Balances were showing a surplus, and also all the tariff concerns from the Trump administration on uncertainty with oil demand. But Brent did bounce off back from $70 levels. Yeah. So it was quite a good chance for players to buy the dip, especially reflecting their concerns on like geopolitical tensions, sanctions on Iran, Venezuela, etc.
Yeah, all that stuff. I've got to say, like watching it, and I was pretty bearish in the last year as the Gaza stuff was unwinding and coming into the Trump, what we thought would be the Trump season and things like that. But you would have made a lot of money every time buying the dip on 70, and it happened, I would probably estimate 5 times. I have to look at the charts.
Yeah.
But it's quite amazing when like every time it feels different, right? You're like, okay, well, this setup's different, it's starting to trend. This time we had a breakthrough on 70 that actually went all the way down to 68. You go, okay, it's a new regime. And then you get yet again, and now they're like over short market, rebalancing to long, loads of longs added from the hedge funds and all that. And then pretty decent headlines and fundamental justifications to support it. So you got to see it from a trader's perspective. Are they going to make money short, or are they going to make money long? Like, unless you're trading options, it's the only thing you can really do. And it's probably pretty frustrating waiting for a good bear move. And it's like, well, look, this is just not happening and things are aligning. Okay, let's trade the breakout to the upside. And because it's materialized, I think that's quite healthy for the market.
I was going to say, that reaction yesterday speaks to what the market kind of wants to see, right? They're like happy to buy into that kind of move.
It's funny because I spoke to a CEO of a brokerage yesterday. He was saying he felt that about 30% of the risk that could be allocated has been allocated in global oil markets at the moment.
Okay.
Like, you probably wouldn't say that with futures because I think there's like all-time high open interest on Brent spreads, something just crazy like that.
Yeah.
But generically, as you look across the whole global market, which is a lot more contracts, that's kind of his point of view and kind of makes sense. I mean, it's if it's uncertain, you're not going to put your risk on, right? So
yeah, and like gasoline, that has been the kind of narrative in gasoline for a bit on the European stuff.
It's probably where he's coming from. He's a gasoline guy.
That like the uncertainty in tariffs, and even though the arb is open and EBOB barrels are cheap, and yes, like EBOB usually rallies this time of year, because there was like uncertainty, it was just, like why would you allocate like max VAR to it?
Yeah.
Especially if there's not like a really, really high conviction underlying story, which like some years there is, and that's when you kind of go like pile in.
Yeah.
So yeah, I can believe that for sure.
Okay. So then we do, what's driving the market, what we like to say, driving the herd. So herd mentality. Vincent, what do you think is driving the herd right now? And just for context, last week we said we thought OPEC was actually becoming the driver because of the sanctions that had come in, kind of the tariffs conversation had died down a bit. And in the context of oil markets, at least, OPEC was kind of in the driving seat, how they were coming back from their cuts, or at least bringing back their overproduction, things like that. But do you think it's the same now, or?
Slightly different. So OPEC has mentioned they'll be bringing back barrels in April. Now the cat's out of the bag. Markets really been pricing that in, but now it's just turning back to sanctions. Firstly Iran, then Venezuela, and then over the weekend about Trump's comments about him being quite angry with how Putin's been acting during the negotiations, trying to also previously market was expecting a bearish outcome with all of this. Trump was maybe more dovish with Putin, but with these comments, it seems that there's there seems to be some raising the stakes here.
Yeah.
Especially with the geopolitical temperature. So that was a big change to the market.
What did he actually say? Like what?
Putin's a bellend, something like that.
Yeah.
No, it was basically like, I think he's just frustrated he's not getting the response really from Putin, so he just came out and said, "I'm pissed off." Literally, that's what we needed to
25% tariff.
Yeah, exactly. Well, no, that's what he said, right? So 25 to
additional, right?
Tariffs on secondary Russian oil.
Yeah.
So that is actually a big deal because
is that to try and punish the kind of rerouting?
Yeah, that's
stuff?
what I'm saying. But as in like, so before they wanted the oil to flow,
yeah,
but they wanted to punish Russia to put a price cap. Obviously, it didn't really work out very well. But with the price cap right now, or where prices are right now for euros, about 64.
Yeah.
And obviously the price cap 60, so it's just doing nothing.
Yeah.
So if Trump comes out in secondary sanctions, like China and India and all the people buying the oil, that is massive in terms of restricting them.
Yeah.
But it's a massive retaliatory move that does raise prices, is what you're saying. So who knew we'd be here, right? The whole game with Trump was to be bearish oil. And now you've got like a setup to be as bullish as last year, maybe even more bullish if it keeps going this way. The only thing I would say though, and this is not to be like, you know, something deep is going on in the market, but it does, you get the sense every year, I feel, that the market either wants to rally or sell off, right? And last year, everyone was buying into rallies very aggressively. It was always a thing that, like, I think the general sentiment had always been bullish. You had shorts coming in from CTAs that are just trading momentum and things like that, kind of caused a bit of volatility. But I think generally speaking, there was a lot of like blather when prices got low and people wanting it to be high. I mean, this year it feels the opposite. Like, you've got bulls, obviously, you always do have bulls and bears, but it feels like this time when we get to 75 now and certainly 77, you've got a pretty decent resistance there psychologically, and you are getting sell-offs, and we've had some couple of sell-offs despite Brent spreads like completely blowing out. Like, we had a ridiculously strong expiry, well, unusually strong expiry given where we were just a week ago, like yesterday, and we could talk about more about that later. But you get this, you get what I'm saying? You get that when you're trading, right? Like, every time the layup's strong, it's actually, and the bullish, like for example, the bullish headline of Putin Sunday night, you come in Monday morning and it was up like 20 cents. It did rally like throughout the day, but you expect a bigger reaction.
You just get a bit of a feeling as to like what, you want to see that like initial, like what the market wants to do. It's quite hard to like quantify it, but it is, you just, because you're there seeing it and then.
I'm spending a fortune on you getting trained to be a technical guy. So what's the...
come on, mate. Time to earn your money.
Is there technical justifications for what I'm saying, or?
Yeah, for sure. As seen on my screen here, so we're looking at Flux chart of the Brent flat price, rolling M1. So there's a lot of technical justification for the recent rally. So yesterday was quite a big one. Towards the end of last week, Wednesday, Thursday, Friday, we were entering a technical resistance zone. So you had the 50-day and 100-day moving averages cross over. So end of last week, Brent tested it on Friday, came off a little bit. But on Monday, there was a resounding break above that level. So in a sense, entering clear air on Monday afternoon. So once that breaks, the next thing we're looking at would be the $76 level. So that's the longer term structural 200-day moving average resistance. So that's a dark blue line.
Okay.
And also in early February, Brent was trading around $75 to $76. So that would be a key congestion area, key resistance level coming up. But it's also worth mentioning that Brent was bouncing off from 69, 70 levels, which were around 3-year lows. So there was quite a lot of, let's say, capacity for the bulls to come in, especially with coming from like really, really low levels.
Yeah. So what was different for me this time was it's the fact that you got a lot of open interest in the time spreads, the Brent time spreads, which suggests that it's like a lot of people taking each other on with high conviction, right? It's not just like loads of risk on in different ways. There's huge sellers, huge buyers with high conviction, not hedging versus spec, kind of spec versus spec. That had all the hallmarks of that because we had pretty aggressive stop out on Friday and Monday, and then we had a strong Brent expiry. And that kind of volatility towards the upside is always interesting because, it's basically someone throwing in the towel. And the thing about that is you need to abandon fundamentals, right? How many times have we been here when it's like, oh, it's not fundamentally justified. It's like, yeah, but has one side stopped out yet?
Yeah.
Because until they do, there's that new flow to come in for them to stop out. So you have to wait for that kind of volatility spike that suggests to stop out, kind of see where the price lands. And if you're going to take on the market, that's the time to do it, because you've now got a more balanced open interest. You've actually probably got the opposite, which is the other side taking profit because they're happy. That's what they wanted to see, right? So I would argue that now's a great time if you believe in this bull market, great time to take profit. If you're bearish, it's a great time to be short. But obviously, if you're hamstrung because you just got burnt, then that's an easy thing for me to say.
Yep.
But that's coming to my mind now. So look, Brent spreads and their relationship with flat price varies, right? There's a correlation of, what do you reckon the correlation is? Like pretty decent, right? Pretty positive. Do you want to guess what it is lately?
Talking about the front spread.
Yeah.
Spreads.
It's probably dislocated a little bit, I would say. It's usually about like 75, 80%, I would say.
But then right now maybe like 60. 70.
Yeah, it's broken, right? I agree. So
Fact check that.
yeah, we'll fact check that. But the point is that it's not direct. If you sell a time spread, that doesn't do anything to Brent flat price in theory, but they do tend to move in tandem. People do look at the time spreads and the flat price as a correlation. It's a big way people hedge. So I think if we start to if we found the ceiling on Brent spreads, if we start to drift lower, if we've got a 200-day resistance on Brent, and the story is kind of the Trump stuff's all a bit of bluster, it's not actually real oil offline, I think it's quite a good time to be tentatively.
Yeah, I was going to say, I guess that Russia stuff, once it sort of disappears from the news cycle, which inevitably it will when some other like crap he says comes out.
Yeah.
Then it's like, then people will start trying to fade that move because it'll be like, that was just like a bit of an empty move up.
Yeah.
And like you say, if everything else is kind of building up resistance, then it's like a good time to short.
Yeah. I do find that most people just, especially in the hedge fund world, just don't want to be short. But this time they definitely have on the time spreads. I think, like you said, the balances, supply and demand balances, Citigroup, Goldman Sachs, everyone kind of announces their global crude balance in particular. And they've all been pointing to surpluses this year. So hedge funds do quite generically trade that, right? And say, right, well, we just got to sell the back end time spreads then. So I think they were probably the big short. And in fact, I know pretty confidently that they were the big short going into this. So they're now a bit hamstrung. So you've got a industry trade kind of probably not wanting to be bearish. So maybe it's a bit of, it's basically a bit up in the air. But maybe what we should talk about is, if you wanted to be bullish right now, how would you structure your trade if you wanted to be bearish right now on flat price? So if you bring back that technical chart back up again. So just going over what you were saying, you're reaching that blue line, not to be like overly simplistic about this, but I haven't got the lingo like Vincent. But
Cool, mate. What's the business?
It's just a 200-day moving average, which is a resistance right now.
Right. So we're saying like, from an industry perspective, I would say it's starting to feel overextended. We've had the stop outs. If you're bearish, you're probably looking to have an entry level pretty much now, and you've got a like a caked in stop loss there, right, straight away. And given it's relatively tight, what are we talking about? 70, it's like $1 higher or like 80 cents higher. So if you're positioning yourself, about a dollar stop after kind of a $3-4 move in the last few days, that's pretty tight. But you can at least like reduce your size right down, have a crack at it with like maybe a quarter of your capital with that dollar stop. And if it does start to trend lower, you got some decent confidence that it can start to wane lower, probably like with a target around like 73. So you could probably scale in kind of every 75 cents and try and target 73. That would be quite a reasonable trade setup.
Yeah, I think like with these moving averages, they kind of become so like, let's say the white line was resistance, now it's become support. So if you were bullish and if prices kind of retrace lower, then that presents a nice entry level to come back in. But then also if you're on the bearish side, if prices close below that line, then it could give you more confidence to add to your short positions.
Yeah. So on the flip side, could we get a breakout here from a technical stance as well? I mean, absolutely, right? There's nothing to say, this is just our opinion, what we were talking about. But on the flip side, things are heating up. As we say, it's quite hot. The geopolitical temperature's warming up. If we're going to get a breakout, I guess you're targeting the same thing, right? You're targeting around the 76.30 level. Yeah, so basically having an entry level above that is probably just above that as it breaks through would probably be quite a good breakout momentum trade. Yeah.
Yeah, so if we're looking at positioning for a long trade here, this is the 200-day moving average, right?
Yeah.
So any kind of entry above that 200-day moving average would be a good setup for a breakout move. And yeah, you'd be looking for like volatility quite soon. And if you didn't see that, or it started to fizzle out and close below that 200-day moving average, yeah, you look to exit the position pretty aggressively because you're looking for that kind of outsized move straight away.
Yeah. And that's just a kind of short-term momentum trade that's usually quite decent around these kind of resistance points. Any other ideas, Vincent?
I think like a huge caveat would be that early, as mentioned earlier, the early February levels was trading kind of flip-flopping around 75 to 76. So that's a key resistance area, a key place where a lot of at the 75 level, which like a lot of it's a quite a psychological level, so people would be looking to trade around that. But if there's some truly bullish momentum, if the fundamentals are and the balls are all on the right side of things, if it breaks above the blue line, then you could also have like the algos and CTAs recognizing this, and it will be literally clear skies ahead. So after that, it just really depends on when bulls are looking to take profit, or like when new shorts are willing to come in.
Yeah, so it'd be like a new confidence level because, you know, you're expecting profit taking right now after this decent move we've had and time spreads doing what they're doing. But yeah, if we restart again, it's a good time to be nimble, re-enter above this with new volatility. But as you say, if there's clear skies, I mean, the confirmations that you can get are, you know, you want to be checking the CFTC report. On Friday, we know that there was a bunch of longs added to the market announced. That's probably going on right now, you would expect. And as long as you're comfortable that it hasn't got to that point where it's oversaturated, then as you said, the CTAs, like they've got relatively wide ranges, right? So for them to break out and switch from short to long quite aggressively, you do need to see it. They probably need to see that breakout. And then once you have that, look, you've got the media that loves coming out and attaching stories to these moves like we were saying last week. And that adds usually a pretty decent momentum. And then you'll get Energy Aspects, Kepler, all these guys being like, yeah, I told you, it's so bullish. And then it kind of runs away with it.
And if Trump does put some meat on the bone of these sanctions, these secondary sanctions, like that's like genuinely like that can really like back things up. And I mean, obviously he's pretty fickle, but that would be like, you would want to keep an eye on that, whatever position you had on, because if that's what kind of caused this like initial breakout yesterday, then clearly like the market is going to want some follow up on that.
Yeah. But either way, staying nimble, I reckon, because you're going to have that great opportunity to be long.
Yeah.
And then I would expect, you know, around these levels last time, every time we've creeped up to mid 70s on Brent or like above 70 on WTI, it feels like it gets back to the White House and they go and release something in the press being like, we're going to look at this now.
Yeah.
So when prices are low, they go, okay, Venezuela, Iran, price is high. Oh shit. Okay. You know, licensing. I don't actually know what they can say now. Maybe they'll go back to the,
they've just got a range trading algo in the White House.
Yeah, 100%. But or at least, no, I just think it doesn't matter when it's doing its thing. But when it breaks to a certain level, it's like, okay, we've got to look at this now because this is getting into inflation territory. And then, you know, we've got to announce that we're going to do something about that. That would be my guess. Anyway, let's move on because we've got a fair amount to go through. So then now we look at basically who's been making money in the last week, which we're calling the gold rush. So Vincent, tell us what's the standout trade you think people made money on?
I think gasoline's been the standout trade, especially like the US and Northwest European gasoline, the RBOB, EBOB benchmark. So on my screen here, we got the April EBOB crack, which since the start of March has rallied from previous lows, so around $11 to $13, and especially in the past week, seen a strong rally. So that's off the back of strong.
Sorry, this is the April EBOB. Okay, Roger.
So kind of seeing a strong retracement from.
And you've technicalized the crap out of this.
Yeah.
Yeah, this is on Flux, all this stuff. So yeah, that's pretty powerful for you technical traders out there, and you can get that free with a trading account on Onyx Markets. But I interrupted you. Sorry.
So it was just quite a bullish time. You had the fundamentals backing it up because that's also related to one of the tariffs trades. Because of the Trump's tariffs on Canada and Mexico, the market would have been incentivizing more imports of gasoline from the European side because of because of the refinery slates, how that's all different. So basically, the ARB, which is the difference between US gasoline and European gasoline, that has been widening quite a lot. So which has been in a sense quite bullish for European gasoline. In addition, you had like turnaround season as well, which has been limiting supply, as well as like reduced exports out of Asia. That's proved to be a really strong thing fundamentally.
Well, I'm glad it's the second thing, because the first thing, I don't think it adds up to what we were saying last week. In fact, we were saying the opposite, right? The ARB has actually been pretty tricky. It's widened because the tariffs, like you say, Vincent. But at the same time, the Europeans don't want to send oil over when halfway through the voyage, you get a tariff slapped on them.
Yeah.
So that's been stopping. If anything, that was causing a lot of EBOB sell-off. So why rally now? Maybe it's been eased a bit. I don't know. I don't think pricing is like going to be that strong. I guess we'll see today being in April. But again, looking at the graph, it's probably just a decent technical setup, right? I mean, you've had bullish Brent and it tends to move into bullish gasoline.
I was going to say, it could very easily be a Brent-driven market as well. Like it's a market that probably wants to be long, especially coming into the summer. I think like last week we made the argument that we felt it was largely like positioning based rally, given that you still had the like uncertainty around tariffs, like the physical underlying market hadn't really put up any kind of super bullish stories, but you have like a really strong positioning element to like EBOB gasoline, especially coming into the summer. So yeah, when you have like a move down like this that you can see on the charts, I think people probably just saw it as a good time to buy. And you do have the element that the ARB is open, so it is economical to move barrels out of Europe.
Yeah,
and it's obviously still going on. It's just we said last week we didn't get the feeling that people were that keen to do it just because of what might happen halfway through the voyage.
And it dampens the whole trade settlement. Vince is trying his best to distract you with moving his papers.
Yeah.
No, what I was going to say was just like exactly that. But ultimately, what do you need when it's kind of a long only market? People want to be long. You're just waiting to see if it's dangerous or not. So that selling pressure we got, and again, the downward momentum that was on that graph quite clearly on the red bar side again, that once that had stabilized and kind of flipped, and there's a bit more confidence coming in, then people just classic herd, right? They're waiting for more people to buy, then they buy, and then they get confident again. And then all of a sudden it feels okay again in gasoline, right? In 3-4 weeks ago, it was panic stations, right? It was a very difficult Q1 for gasoline traders. And maybe that's all it is. And that's all it has to be. It's all it needs to be.
That's all it needs to be, yeah.
It doesn't need to be some big fundamental justification. I mean, you sound like the media now, right? With your whole turnaround stuff. I mean, it's possible, but I would say like, this is the difference like when someone says, oh, I can't trade oil because I need all this like information. It's like, it's bollocks, man. People are giving the story after the fact. Like that technical setup was clearly a decent stop out on this fear that stabilized, and then you had a decent momentum and you could have easily traded that on a technical basis, right?
I think for sure. I was also just wanted to add on the positioning side. So from the CFTC data, the money managers or the funds were clearly quite bullish on US gasoline on RBOB as well. So the recent week, we saw the highest level in fund net positioning since mid-February, from being at its lowest, it's been rising from really low net positioning levels. So clearly, a lot of the funds, they were seeing these opportunities to buy in the dip as well.
This is an RBOB?
An RBOB. And perhaps maybe that could be correlated with crude strength as well. So adding to that flat price positions.
Yeah. Okay. Cool. So we think that was the one that made money, and probably range of players there, right? Trades, corporates, and that's it. That's the main one. Do you think anything else?
I think that's the main one. But also on the EBOB crack side, something we observed open interest. You'll have the chart up there. So on the April EBOB crack, we saw 3 consecutive day-on-day decreases in open interest, which sort of suggested maybe if the price action was going up, then maybe shorts were either stopping out or people
taking profit, right? Yeah, no, that's fair. That's fair.
Which makes sense into expiry as well. If you're not so sure about what expiry is going to do,
that's a good point. We should probably just quickly touch on that.
Yeah.
As you approach so if you're trading the contract month, these aren't rolling indexes like funds. I mean, ironically, we are going to create those, but when we say you're trading month one EBOB crack, that was April because that's the next month, but now it's in April.
Yep.
that's now pricing to, you know, a PRA's, a price reporting agency's determination of what the actual price should be. So that involves physical prices, and that's kind of where the chickens come home to roost, right? So like to your Harry's point, it's you want to be out of that trade in April once you get to April if you're not really certain what the physical is going to do, right? So that's what you're saying.
And on the European cracks as well, you have you've got your product element, in this case is EBOB gasoline, and you've got your Brent element, and your Brent element expires at a different time to your gasoline. So that becomes kind of detached and expire anyway, that even if you wanted to express the view, you're effectively now holding just two separate contracts which are pricing, and they don't really have you know, you might like gasoline expiry might be really bullish like you thought, but if Brent expiry is also really bullish and you're holding these positions like against each other, like
it's a great point.
The crack might end up just pricing at a completely arbitrary number.
Yes, because what does it actually mean? It's a relative value trade in a way. So if you were bullish the physical then because you believed in Vincent's story about turnarounds being strong or whatever, what should you trade then as a trade expression?
Well, then if you had the long crack position, let's say, you could convert that into a long EBOB time spread position. So
massively agree.
Trade out the crack and you could buy the April-May EBOB time spread. And then you've got more of an expression of gasoline rather than just this kind of...
Yeah, the time spreads are fascinating because, again, this is too long to go into now in full detail, but the time spreads are basically reflecting storage economics. So if it's positive, it's saying, you know, there's a lot of demand right now. If it's negative, you're incentivized to store it to wait until next month's demand. So the way it's priced is the way you kind of judge the economics is kind of that. But then it's also actually the way that Platts in particular, or Argos in this scenario for gasoline, for EBOB, they are using not gasoline physical prices outright. They're using physical prices that are referencing month one. So they're saying, right, April cargoes versus May EBOB benchmark. So basically April physical versus May financial. That differential is what's going to settle the April price. So that is a time spread. Like, it's going to be confusing to hear that if you've heard it for the first time. But the point is that the time spread genuinely relates to the physical prices that settle the window. So it means it's a real reflection of physical. So you can say, if you hold the time spread, I'm reflecting a physical position. And that's quite important. But as you say, the crack, absolutely not. Like it's a relative value thing. Right? In fact, you can even have a weak gasoline market and the crack rise, right? In theory, right?
Yeah, on a pricing basis, for sure.
All right, let's move to the Widowmaker. So this is what's lost people money, and we've already mentioned it, haven't we? I think the obvious one here is the either the Brent spreads or let's say the DFL, right? The dated Brent.
DFL,
So I guess for me, having a look at the dated Brent traders at Onyx, I mean that was in some respects, if you kept believing that the market was going to bounce off these lows, you could probably see it coming to some extent. And I would only say that because Manny actually did in our Trading Corner episode last week go sell EBOB, buy DFLs. And actually, to your point, EBOB is being strong, but the EBOB versus DFL, I think, is actually weakened.
Because the DFL,
or at least it's been you wouldn't have lost money because
the DFL outperformed EBOB basically.
But anyway, just sticking to the DFL side, I mean, the volatility was insane. And I think the thing with DFLs is basically dated Brent minus Brent. And I think you've got to look at it like a Brent time spread. They are basically the same thing when you look far out. So for people new to what is dated Brent, so just think of it like it's just the OTC version of Brent spreads. You buy this differential and it's meant to be reflecting spot physical and North Sea, so the real physical barrels. And it kind of stays quite like in a range with the time spreads. But when it really goes berserk, it massively outperforms the time spreads. And that's because the spot is outperforming the forward market. So that really happened this time. And this kind of volatility only happens when there's stop outs. And that was our point before, right? To get like a dollar move or more in a DFL is like monstrous. In fact, when I was trading, a dollar move was like an entire year's move.
I was going to say, a daily move could very acceptably be like 3 to 4 cents on a DFL, right?
Standard, yeah. And I mean, it's indicative of the times, but it's quite an incredible move. And the positions people put in the dated Brent market, we're talking like the average trade house has probably got 5 to 10,000 lot positions on regularly, up to 100,000 lots. So 100,000, because a lot is 1,000 barrels.
Yep.
It's 100 million barrels.
Yep.
So it moves up $1, it's $100 million. The amount that's made and lost in dated Brent is insane. But it's also the reason why I think it's so able to have that liquidity and sustainably have that liquidity is because there are so many hedges as well, right? Refiners use it to basically hedge their spot barrels for their physical crude into their refinery. So you're constantly having refiners and producers use this dated Brent contract to hedge. But then on the flip side, the people that take that liquidity or give them that liquidity when they want to sell or buy, they are more kind of like speculators, and they kind of control the physical barrels and where it ends up pricing. So when you get a move like we just had, yeah, should be a pretty big winner out there. And I think we know who the winner is, and there's a couple of big winners. But you can also know when like the majority of the market lost money. And that's why we're calling this one the Widowmaker, right? Because there's like, the majority of people were short, I'd say. And there was some stealth buyers who, to some respect, I think got lucky because, you had the Brent momentum and you had the headlines, but they took a position on the physical North Sea. Yeah, rumors are that there was a lot of crude being taken on the downturn to Asia, like booked to Asia, which people only learn like a few weeks later. And that kind of materialized. And again, you could have potentially noticed that when we were talking about Brent-Dubai, when Brent-Dubai is so low, it incentivizes moving barrels from the Brent price regions, i.e. the west to east. And so people always forget about that because they're in the moment and it's getting caned. And we didn't even talk about it last week. But you got to understand that when something opens up like that, someone's going to move something. It might not have a huge impact, but it did have an impact this time. And it caught people unawares, and it caught, when you catch a market short and they stop out, that's when you have the volatility. So, I mean, that's the story in a nutshell. You got anything to add on the technical side or a positioning side, maybe?
Yeah, definitely. On the technical side, on my screen here, the DFL, that's April 25. So you can see the consecutive monster green rally, especially on Friday and Monday.
This is April again, yeah?
Yeah, okay. April again. So up to $2, where that finally saw also resistance. But you see the green candles really large, like wide bodies, the thick long bodies, Marubozu candles, which indicates on a single particular day, it opened lower, closed very much higher. So essentially meaning that the buyers, the bulls, or the short covering flows, the bullish flows were in control for the whole day, for 2 consecutive days. And it was clearly a volatility breakout to the upside. And
this happened over 2 to 3 days.
2 to 3 days, yes.
You had some decent chances to get involved with that rally. So again, this is what's so untapped about OTC or global oil markets. That would never happen in a futures market. It would never be that smooth of a ride upwards and then giving you multiple chances to enter that. Look how many times you could have just bought and been under no pressure. And, look at the range before that. So you could quite comfortably hold, let's do the maths on this. So like the DFL was around
60 cents when it started, 50, 60 cents when it started to move up.
Like
so
aggressively move up. Like before that it was probably like 40 even, right?
So it kind of ticked up from 60 was where you started to get the kind of bigger candles. And then when it hit like a buck, that's when you got that first monster candle. Which
but what I'm saying for the maths, so like, what would you think is a reasonable position? So if you had $1,000 to put on dollars, a very, very reasonable stop is $1 on DFLs. To be honest, is too much.
Yeah,
I would say 30 cents, and something's wrong. Like if it moves 30 cents offside, then you've structurally got that wrong. So I would say you buy it at 40 with a 30-cent stop, or 50, 30-cent stop.
Yeah. So if you had put this position on here around 60, 70 cents, with even $1,000 in Onyx markets, would have still got you between 1 to 2 kb of exposure.
At least, right? You probably stretch that to 3 kb. So if you had basically $1,000 and your stop was 30 cents, so you times it by 3 roughly for the size, right? So it's 3 kb.
Yep.
And then you would have been making like at least 50 cents, maybe $1.
Yeah.
Quite like just watching it and waiting to stop out on a pullback, and the pullback never came. And that's a decent $5,000. Yeah. Basically. So that's not bad. And then obviously you can scale that all the way up. And as I said, these big trade houses and all that, probably the big bull out there that made money out of this would have had Yeah, he would have easily had 50,000 lots on,
Okay.
and probably would have been long the time spreads as well.
Yeah.
So that position would have been like a big money maker. But then you've got the physical costs on the other side.
Yeah.
That this big bull, like by moving the oil out of the region, by basically laying this whole trade up, it's quite expensive to do.
Do you think that they would have sacrificed P&L on the physical side to effectively create the conditions to like cause the rally in data, basically?
Yeah, I think so. But I think also like that's kind of the whole point, isn't like it starts off as a hedge, right? Because you're like, well, I'm buying this oil, I'm going to buy the DFLs, and ultimately they're kind of working with each other. It's when you buy more of one, then it becomes a leveraged position.
Yeah.
So I think probably seeing that is looking good.
Yeah, fair enough.
You buy way more, and then you end up losing on the physical.
Yeah.
Because
but you just see it as like a business cost.
Well, yeah, I mean, you're basically seeing the prices go to the moon, and you're going to lose on the physical that you've sold to different regions.
But if you're leveraged, 50 to 1 or whatever,
you don't give a shit.
Paper, you don't give a shit.
Yeah. So, I mean, that's all the setup of people misjudged the physical setup. And this is the thing people don't understand about physical. It is spot, but it's still a bit of speculation because the barrels you need to influence April is the end of April to May barrels. So you need to have quite a forward-looking view on what the physical is going to do. And if you're going to send it to China or to Asia, you're going to need to have figured out their demand like 3 months ago, 2 months ago. So you're making your calls, you're having your relationships with them, and you're trying to build a picture. And then the bears are doing the same thing.
Yeah.
The physical guy's like, right, well, let's buy a bunch of physical to sell into the market, be short, that kind of thing. It's like the opposite play. But ultimately, it's all speculation because no one knows what's happening with the physical. So when it starts to gain traction, the most important thing is what I'm saying is it still comes back to stopping out and pushing someone to stop out, because otherwise you don't get the move that you need for it to win, if you like. It's a very like zero-sum game when they're against each other. But it's not a zero-sum game for the hedges because obviously they're making money on the physical side. But that's what makes it so fascinating, right? There's always like big bull versus bear.
Yeah.
And the officials guys always go on about it. That's our free report that Jorge Mentepeke puts on LinkedIn. And he kind of like dramatizes the games that are going on there, maybe to his detriment sometimes, certainly mine. But the point is that is what you're looking for. Like, so if you're trading the DFLs as a retail trader, professional trader, whoever, you don't need to necessarily have all this in-depth physical knowledge because you never will, right? Never competing with those guys. But you can watch the layup. You can watch the positioning. You've got our data. You can look at the technicals and kind of say, look, if we get a breakout, the thing with DFLs, if it breaks out, it breaks out. Like you're not really getting like ranges. So we have a range for a while and then it breaks out and it goes to the moon, or vice versa. You get these like restructurings from time to time. So there's a lot of, I think it's very forgiving if you're a secondary participant, because you just have to wait for the move like that. So that showed, right?
Yeah.
But then if you're an algo and all that, then they would destroy this. But algos aren't in this market yet.
Yeah.
So if you're a trader, it's like trade these markets because you're used to markets that are so inefficient. And when we say efficient, we don't mean the bid offer. We mean the price moves, right?
Yeah.
Like the algos will price this in a second, or like chase these moves in a second. That's not what's going on in these markets.
Yeah, for sure.
Yeah. Anything else on the Widowmaker? Anything else people have lost?
I didn't have another one.
Yeah.
I looked, but I didn't have another one.
So hence why we said the market's pretty decent right now, right? Most people have probably made money across the board. And
Brent-Dubai had a small move up, but that's not a Widowmaker, right? That's just profit taking.
It's profit taking. A lot of people were short, weren't they?
Yeah.
And in the same respect, the DFLs, that was we were saying last week, that was quite a predictable move as well. That you could have jumped in on and done quite well on.
Yeah, for sure. Yeah, we was trying to think what our like major reasoning last week, but we saw the setup on Monday, and we recommended it as a trade to Onyx Markets clients and like regular clients. So yeah, I don't think we expected the like stop out volatility like that, but I guess, like we were saying earlier, it's still like you can see these setups happening. You can trade them. You don't need to be like me and you on in the market all day every day.
In fact, we're going to prove this, aren't we? We're going to do it soon. We're going to get on the live stream, and we'll do this together, right? We'll be talking shit, and we'll look at the market, and we'll just try to gauge from what we're talking about, you know, and trying to see if people out there you know,
Yeah.
how to look at
But
it. So
there's no info that we had access to that our customers like couldn't have access to.
Well, that's the thing. And I, you know, to be honest, I can go over to the data Brent traders and they're very in the know, but I'm not going to do that like 20 times a day. Like these guys, you have to be very in all day, switched in, plugged in, know the relationships to have that kind of edge. Don't even try and have that kind of edge. That's what we're saying, right? You don't need to.
Yeah.
I mean, these guys are trying to make increments every day.
Yeah, you might not see the same trades that they see, but like, you know, when there's a setup and like we can see it, it's good that we can like pass that on to customers. And
well, ironically enough, I've seen market makers if they want to prop trade, they do a lot better by moving off the desk, letting their team market make have a fresh mind and do that. Take a look back and just look at the layup and make better judgments. Because if you're in the market buying and selling all day, you get influenced by like big volume and big moves.
I actually think that my like sense for prop trading has improved since I stopped trading.
I believe that for sure.
I actually was when we were discussing trades on the brokerage side and even on the market side, I was like, it's really weird, but I feel like I'm better at calling the market now than I used to be.
The only anecdote I'd add to that is, you know, I used to have a competitive trader when I first started who was at a bank, and basically he was like a big volume trader, and all the trade houses were quite interested because like, how is he trading against us? Like, what's he doing? And like, then obviously I was figuring it out. It's basically just trading the curve, market making stuff.
Yeah.
And I started to form like direct relationships. Like, oh, if I come to you directly, will I have, you know, could do these trades without the brokers and all that kind of stuff. And he said, yeah, I used to do this with this guy. Like one of the trade houses said, when we were at a restaurant, saying like, yeah, I used to do this with this other guy you're talking about at the bank. But every time I said to him, you know, thanks for doing this, it's really helpful. Should I give you some information about what I'm seeing on the physical side? He'd be like, no way. Because every time that happens, it just messes with my mind.
Oh, right, okay.
Well, this guy's taking on the entire market, right?
Yeah.
Like in terms of the flow and all that, and able to trade very effectively. And he doesn't want to know the physical information.
It's interesting.
Isn't that interesting?
He just sees it as noise.
Well, yeah, because it's and if anything, it's like
It's not what he wants to trade off the back of. So he doesn't even want to consider it.
Yeah, exactly. But also it's easy to get influenced because if someone's saying, oh, it's really bullish, because this trade house is really bullish, the brokers talk it up, everyone goes to the pub and talks about how bullish it is. And like, then now all of a sudden you want to be bullish and they're actually getting out and all this kind of stuff. So you don't, you know, that's where you just don't want to be. If anything, if you're doing that kind of stuff, that's the definition of secondhand information. You're hearing what they want you to hear.
Yeah.
So yeah, interesting. All right, moving on. So let's do the more of a analytical side of this, which is the deep dive. Vincent?
Onto the deep dive. So on our deep dive report last week, we discussed the Brent-Dubai, so difference between Brent swaps, Dubai swaps, Middle Eastern and Atlantic Basin crude. So onto the Q4, which was particularly interesting. We have it on the screen here as well. So recently the whole Brent-Dubai forward curve shows.
So this is Q4. So like we were saying before, month one is now May.
Yeah.
Was April. But you were talking about the Q4 contracts.
Yes.
So Opnov Deck 25.
Yeah, more specifically in the Q4. So to set the context, the whole curve had been quite weak. To speak like the market, you know, fundamentals like all the sanctions stuff have been priced in, the maximum pressure sanctions on Iran, all of that leading to potentially like more tightness in Dubai market because of China and India aren't going to be buying from them. They're now going to be turning towards more of that Middle Eastern crude. So it's natural that.
Well, it's just more scarce. The Middle Eastern crude is more scarce, right?
Going to be more scarce.
Yeah.
And also you had like VTOL being the main buy side in the Dubai physical as well. So what we've been seeing is that like Q4 saw like a really rapid sell-off. Our data was showing that trade houses and funds were very much on the sell side. So at these levels, it could potentially be, could see a mean reversion coming on, especially with the bearish news priced in. The front has been seeing a bit of strength, and looking at the average entry levels. So shorts are very much in the money, whereas some longs have stopped out. But positioning shows that much of the market is on the sell side. So what does this mean? So if prices were going to go down, we think the downside, so to go even deeper in the negatives, that's more mitigated because the existing funds, existing trade houses might be more keen to take some profit on this. Whereas if prices go up, then there's more room for the upside, and there could be a volatility breakout. So what this means is, if you're in the money, if you're in the green, the market goes against you, you would want to be taking profit pretty quickly. So we think there's an asymmetric risk, meaning that there's more chances at these levels for prices to go up than to go down. We cover it deeper in our deep dive report for a bit more on the details on the kind of parties and the positioning, open interest, but that's the gist of it.
Yeah, you sound like Rain Man with a Kiwi accent. Charlie Babbitt. But no, it's good. I think to add to the story there, I mean, like, you do have the asymmetric upside with the positioning and the price. Basically, you're saying it's at historical lows, the risk reward. But you've also got what we were talking about, which is when something happens in the North Sea, like it has, and it's very related to the physical in the North Sea, then it's actually worth looking at the data Brent versus Dubai, which is very strongly correlated to Brent versus Dubai. It's pretty much the same thing. And if you've had fixtures because that differential is too low, and you've had fixtures from one region to the other, then as that starts to materialize into the market and happens more and more, particularly West African crude that's priced against Brent, as that starts to more go to Asia, it takes time, right? It's a bit of a lag, but you've got a very wide Brent-Dubai differential with a really, really short market. That also sets up, you know, as the physical starts to evolve and you see the shift, then these shorts you're talking about do have to take profit, or maybe a new buyer comes in and they have to scramble and you get a bit of bullish momentum. And I always like this setup for Brent-Dubai. It tends to trade like this. It gets to extremes and then it stabilizes, and then you've got a pretty decent return on it. So on the way back, but yeah, it's just being in a perpetual state of short positioning the Brent-Dubai, because we've been 5 years in of OPEC cuts. I mean, when I was trading 34 million barrels a day was the OPEC quota. Now it's 28 or something. You know, this is crazy. So we've basically reset the Brent-Dubai range way lower, but even this is very low on a low Brent-Dubai range. So no, I completely like that setup. Thank you for that, Kiwi Rain Man. So, yeah, let's do the Onyx Beta. So this is where we look at the generic contracts we think that generally reflect oil price movement, not just the outright price. So we've got Brent, we've got the time spread, M1, M2,
EBOB crack,
the EBOB crack,
and the VLSFO
and
crack.
the VLSFO
Sing
crack
VLSFO crack
in Asia.
Yeah.
All right, let's start with Brent then. Do we think, after what we said at the beginning, that we're going to keep rallying, or are we bearish now?
I think I personally think we'll keep rallying until more like 75, 76.
Okay.
That's where there's going to be more resistance, and we'll need to see more.
You think there'll be a vacuum up to that resistance point? That ceiling, rather?
No, there won't be.
That's what I mean. Like, it's right now it's 74.50.
Yeah.
And you think that's at 76 is where you get that 200-day average. I'm saying, do you think there's a vacuum there, or just drift up into that level?
No, I think there'll be increased volatility, increased like sell side pressure.
Oh, right. Okay. Understood.
Because that's where like it was trading at previous levels. That's where it was like a lot of market action around that.
Yep.
So I do expect more of that, say more people to come in at 75, 76s. But if it breaks above 76, then there will be a vacuum.
But you've got to make a call. So you think bearish, right?
I think bullish.
Oh.
Bullish up to 76.
Okay, mixed signals. on a week-to-week basis, bullish. That's fair.
Yeah, I think I would be the same at the moment. Yeah.
I'm going to go bearish. The reason why is because, as I say, I just noticing the way people are behaving around the outright price, and it's so political. I think we're due some headlines towards the downside. And it was just the Putin headline not doing much for oil. That was weird. As in, like, I think it was even my dad was saying, "Oh, do you think this Putin stuff is going to cause a price rise?" I was like, 100%. Like, tomorrow morning it'll be higher, and let's see. It was up like 20, 30 cents. Then it did rally, but I would put that down more to Brent expiry being strong. Not look, who knows? But my point is that once you get towards 75 or more WTI up at 70, 71, I think White House is going to come out and say some things. I think it is a flat price.
I think it is pretty capped, but yeah, I feel like, I don't know. I think it's got a little bit more legs in it.
No, it's fair. And remember profit taking as well. Like, I'm looking at the time spreads as well. So maybe I'm a bit too biased towards the industry. And guys out there probably don't want to miss this move on the hedge fund side, the retail side. Maybe they are, if anything, only just getting in. So that's fair. But we've got a decent dichotomy there we can compare with. Brent time spreads, M1, M2. So that's one's expired now. So we're now looking at June, July. The Brent time spread. So basically, as we said earlier on, that's a very physical thing. Is the physical market strong or weak, or will it get stronger?
Yeah.
Basically, is what you're saying with the Brent time spread.
I guess it's set quite toppy at the moment, right, with this recent rally and dated.
Do you have a graph on the M1, M2?
Yes, this is the one.
Go on, Harry, sorry.
Yeah, I mean, I guess given what we've been talking about in dated Brent market, you've had
it's real time going lower, right?
You've had that kind of pain.
Yeah, kind of open lower today.
Event. So yeah, now I suppose you've got a lot more room for people to be entering on the short side. Yeah, you kind of see it. Open lower than the than Monday's open even, and trending lower. So yeah, I think I'd probably be more bearish on this.
More bearish on that.
Yeah.
Okay. Vincent, do you back that up?
Yeah, I agree with Harry. So we saw like 9 bullish days in a row.
And technically?
Technically speaking, there's this blue line just below the green candlestick. So that's a bullish trend line. It's been like matching nicely with the lows on previous days. But this morning it really opened lower at the first red candle we've seen in a while. So what it means is that if it closes below that, then technically speaking, a lot of people it'd be a signal to a lot of bulls to be exiting positions.
Technically speaking, that's a good line for a show. Yeah.
Yeah, it's probably some shows out there.
Yeah, so that's your bearish as well, yeah?
Yeah.
All right, EBOB crack then. So that's probably a hard
What
one.
about you on Brent spread?
Oh, sorry. Yeah, I think in line with the Brent view, I think that's bearish as well.
Mm.
So, okay, so on the EBOB crack, we've had, as we say, a much more orderly rally. I think I'll start with this one. I just think given the orderliness of it, and if I'm bearish Brent, as Harry rightly said, it's a crack, right? So it's gasoline versus crude. So of course, that does tend to rally when gasoline's strong. But at the same time, if Brent is the driver, you can see, if I see Brent getting weaker and gasoline's relatively orderly and not oversaturated or overstretched either way, then I think it stays orderly. And I think actually the crack kind of drifts up higher. And I think there's nothing to say there's a shock coming because we've had the shocks and we're getting closer to summer, like you said. So that'd be my view.
Yeah, I agree. Yeah,
concur?
I think.
Do you concur?
I concur. Also,
we need that meme in what was it? The
catch me if you can.
Yeah.
Do you concur?
Why didn't I concur?
Dr. Harris,
Yes?
do you concur
Concur with what, sir?
with what Dr. Ashland just said? Do you concur?
Go on, Vincent.
Yeah, generally concur as well. Just saying that there's a bull line. There's a couple of resistance levels we need to cross through. But generally speaking, the market does like to be quite bullish with summer gasoline, and if there's some unexpected refinery outages and stuff, it's like the market's well prepped for another move higher.
Decent, thank you.
So we all concur.
We all concur. So it's the low sulfur fuel, which we need to get a better handle on, right? Like how it's a good proxy for, of course, shipping fuel. It's kind of like almost like it covers almost fuel and distillates, right? Shipping fuel and distillates. So it's a good kind of heavy part of the barrel-ish, depending on how you look at it. So I guess one thing that we haven't mentioned is like RBOB versus heating oil, like gasoline versus distillates. That's been a trade this year that people have been kind of riding up a bit. I think generally speaking, if gasoline's going to perform and you've got kind of naphtha cracks still at the high levels and Brent performing, something needs to give. So on a refinery margin basis, you'd expect that, I would say, to be fuel oil and kind of maybe even distillates happening down. But then you've got, if the OPEC stuff's to be believed, that we are going to get less Iranian, less Venezuelan, then that's less fuel and distillates in the market, given how that crude gets refined. So this is a tough one, isn't it? Any thoughts?
Yeah.
Do you have it set up?
I had the fuel oil crack one.
Not the VLSFO?
Yeah, this is
0.5.
Okay, cool. So whack it up.
It's just been quite sideways, isn't it?
But it's been breaking out towards the
It's been
upside.
breaking up, yeah.
Very sideways until the last couple of days. So
But if you were a technical trader, you'd be saying that's very much looking bullish, no?
it's a bullish time because it was like before high volatility, but then big consolidation. So the pattern we saw that was like Martha put up last week, descending triangle, and so now the prices, it consolidates into one point, and now it's going back up. So essentially, what it means is like this could precede another volatility breakout. So for the traders would be extra cautious with their risk management because the ATR would be quite low right now, but it might precede high volatility in the future. So it could mean that if something were to happen, the move would be quite big, or it is likely to be.
I think this is interesting. I think it's maybe actually underlooked because now we usually go to like what our trade of the week is, and I would say, given everything that's going on, you know, you've missed the Brent-Dubai move to react to OPEC, Iran, all this kind of stuff. But if we think more physically now, and as you said, we've had a lot more cargoes moving east. There's going to be kind of a shortage in heavier crude, and we've got a shortage of potentially just products in general. And if Russia's going to be squeezed again, then you probably would say that distillates is probably a bit oversold. So a good way to reflect this, if we think Brent's kind of slightly overdone, it's more on the lighter side, I would say maybe naphtha versus VLSFO, naphtha versus fuel. So naphtha's still like what, -3, -250 on the.
I think it doesn't really move too much.
That's high, right? Historically. Yeah. And as I say, if you've got to rebalance the refining margins based on what the crude complexes are doing, so generally speaking, Middle East tight, then you expect the fuel and disti to perform and vice versa. I think that's a fairly good shout, and it's something that's maybe gone a bit unawares. So I'm going to say I quite like being short naphtha, long VLSFO here. But anyway, we were talking about the beta, which I guess means I'm bullish the VLSFO.
Yeah.
Do we agree with that?
I think, there's room for upside. I concur.
You concur, nice.
Yeah, I feel like I concur as well. It's not been like, I don't really have any like overwhelming conviction on it, but it does feel like it's kind of consolidated for a bit. And I mean, it feels like it's been testing like a bearish market for a while and hasn't really moved. So
yeah.
Okay.
Well, I think what we could do differently to last week is put on a trade idea and maybe talk out the risk management right here. Yeah, so I think short naphtha, long VLSFO is quite hard to get up in the charts. We'll do that maybe for next time. So let's go back to your Brent-Dubai example. So long Q4, I think it's a good trade for a number of reasons. The short positioning that's oversaturated is in the prompt. So I like the fact that you moved it to Q4. So when with the forward curve, you've got, let's say May is prompt, Q4 towards the back end. If May continues to weaken, then what you see is May versus Q4, like the spreads, how the forward curve works, the back end's a lot lower volatility. So it's quite safe being long Q4, even if the market keeps weakening, because the structure will correct. So on the flip side, if there's a bunch of buying, if it's weighted towards the upside because there's too many shorts in the prompt, you'll still get the move in the back end. So I completely see your point about the asymmetric kind of setup there. But let's look at the chart and come up with the structure.
Yeah, it's already up right now.
Okay, so we're looking at minus 23 right now on Q4. So so let's take the minus 50 cents. Let's say at that point, you're not just wrong. You can clearly see like you're trending into a new regime. You're no longer stable. You're trending south, and the whole point is we're saying it's stabilized. So that's a ample stop to have. So if you got $1,000. 25 cent stop, basically that's 2 KB. 2 KB. So that's if you've got $1,000, 2 KB, buy at minus 20-ish if you can, around there. And I think what you're looking for, Vincent, if you want to capture a decent move, where's our target level? Is it just back up to the normal levels, which is around plus 30 or?
Plus 30. So for 25, well, if you have a 25% stop, ideally you want a 2-to-1 risk reward. So 50 cents.
Well, unless you scale in quickly, right? So you have an initial 25 cents and you scale in after 10 cents aggressively and then you basically ratchet up your stop.
You can even move your stop up. Yeah.
So we could say buy at 2020. What if we see a move to like probably minus 8 or 7 cents? I would say that's your last chance really to capture the bulk of the move. So you kind of double your risk there. So another 2 KB if it's 1,000. So you've made roughly, let's call it like 12 cents. And you're then going to buy double. So then you can just move your stop loss up to the lows.
I was going to say, you can just keep moving your stop up. And then even start like trailing a stop if you got into like positive territory if you want to.
Yeah. And it's a relatively like smallish range, but I would expect it to be quite stable and quite a comfortable trade to be in. So that's like a relatively decent layup trade, I would say. The problem is that if you're not having that big of a move, we're talking like maybe a 50 cent per barrel move. It's decent, but like, you know, to really do well, you've got to get that scaling pressure. And the problem with scaling in OTC markets is if it's rallying and you try and lift as it's rallying, you're going to get a bad offer.
Yeah, your execution goes bad,
your execution. You kind of need to wait for a little pullback in a scale up situation, and that's and we could do more of this and get more detailed and do it with a simulator, you know, and the demo and stuff like that. But okay, testing our capability a bit here. We've got us in the studio, and we're now going to go to the officials team, which is our publication team, aspiring PRA settlement data team. This is Ed and Will. They are at their desk. All right, guys, how's it going?
Very good, very good.
You can hear us, cool. So I think this is a good time to get you guys to talk about Dubai pricing, right? That's this concept of pricing for people who don't know, or even people who do know what's going on, what's the latest. We mentioned it in the podcast we just did, that when you get into a new pricing month, that's, you know, risk that people have been holding that are carrying into April, and that's when the physical starts setting the price. So it's really can be very volatile, can be very interesting, and it's when the chickens kind of come home to roost. Is the physical supply or demand really there? So guys, take it away. What are you seeing this morning, being April the 1st for Dubai?
Yeah, so the first Dubai window of the month, we were kind of debating whether we were going to see a return of VTOL, and they were back with a vengeance, and it's more of the same that we saw from last month with PetroChina and VTOL really going head to head. PC on the sell side and VTOL bidding pretty aggressively, and we finished the month last on Friday with a premium of around 212. So pretty strong still a really quite backwardated market in Dubai. And this time we were wondering, are we going to roll down? Are we going to see the premium come off a little bit? And it didn't. So VTOL really against it.
They came in today, like you say, with a vengeance. They came in with a lot of desire to buy from PetroChina. They got 2 convergences in one day because they have to start again from scratch when it comes to convergence.
So describe the convergence as well, like the way that Platts settle Dubai. You know, they use partials, so 25 kb parcels. They trade with each other, and if one counterpart with another counterparty gets to 20 or 25,
20
partials, it converges to a real physical cargo.
Yeah,
exactly. So 500 kb partials, 500 kb cargoes. VTOL's got 2 of them in one day. That's 1 million barrels in a day. So that's nearly 1% of global oil supply.
Shows they actually want the physical, and I think it's the same yesterday on the North Sea. Bidding up 40s, things like that. So it looks like the physical, the desire to own physical barrels is clearly there. Like this big move up in Brent spreads, DFLs we've been talking about on the podcast, that is obviously filtered into Dubai as well. So that's not really surprising. And you're saying so as Chinese counterpart on the other side, so looking to actually offload their barrels, probably pretty high price, pretty attractive level to do so. But there's no real big fight there, would you say? It's just basically a strong market, right?
Yeah, I mean, it was PC have been offering pretty aggressively last month. They were really trying to force down the premium, and at the start of the month last month, the premium was a lot softer, and it averaged about $1.35 throughout the month, and then VTOL really kind of ramped up towards the end, and we saw the premium drive higher, and this month we've seen a return of the same. So we'll probably see that continue.
And you refer to VTOL clearly wanting the physical barrels. They've got enough of them because last month they bought nearly 20 million barrels in the Dubai window alone. So
39 convergences last month. That's more than Totsu in their play. November,
but again, you wouldn't do it unless you had the outlet. So I think that's what we were talking about today. Like the kind of caught the market unawares on this move down. So we've aggressively retraced back and kind of. The market's basically vulnerable, right? Because it was pricing in as if there'd be a hell of a lot of oil online, and there really isn't. So I guess we had the strong Brent expiry also proved that as well. Do you want to talk a bit about that, yesterday's Brent expiry?
Yeah, I mean, as you talked about in the podcast, you know, we kind of started with a string of pretty aggressive stop outs and short covering from last week, and that sort of really set the tone for expiry. And we were talking to one of the traders, and he was saying it was insane. You'd sell CFD at 110, and then it goes bid at 115, no trades in between, and it was just really super strong. I mean. If we look at the Balweek CFD on my screen here, you know, in the 4:30 window, we traded up from about $2 to $2.40 within the space of half an hour. So really pretty aggressive moves. And the cash windows were bid as well. So we had Gumball really. Yeah, one name was repeating in the cash. They came up quite frequently. And the Major cash spread was held at like 103 in the final window. Last month's expiry, the April-May cash spread was only 43 cents. So it's, you know, it was a much stronger.
The physical was as well, wasn't it?
Yes.
If we look at the our dated Brent assessment on the day, it was $2.72 up. It like futures were well up. They were, I forget exactly the numbers, but $1 plus up on the day. But dated Brent was really the one that was flying, and also the physical diff that jumped 53 cents in one day to $1.12. So the physical was really flying yesterday as well. So it was kind of like universal through the dated Brent complex.
Okay, it's a big correlated move, and for once, kind of physically driven. So yeah, kind of strengthens the argument that this is a pretty hot market right now.
Yep.
And I guess when we see these things in pricing the first day, it tends to stay that way, right? For at least the first 10 days, it doesn't tend to be a big shift the other way. So you have to say, kind of lend support to the bullish momentum.
Mm-hmm.
We'll get more from you guys another time. So thanks for that. It's the first one from you. And appreciate it, guys. Thank you. Look, that was great. And thanks, guys. I think we'll leave it there.
Cool.
Thanks, audience. Again, please, feedback. We'd love, keep watching for more and more interactions. If you like the demo idea, streaming idea, anything like that, let us know and we'll try and deliver it. So thanks, guys, and see you again soon.